actually it's about portfolio management, how to manage your positions and also practice good risk management like simultaneously. You get it? Yeah. That's specifically what today is really about. But then as we've already talked about, like since day one you guys started, the preaching or the message has always been about risk management. It has also been about like position sizing and all of these. You get it? And up to now, I know that a couple of you really know how to mark out positions, take trades, execute trades and stuff, right? Yeah. So if you are on today's call and you don't know how to mark out positions, like how to see setups on the market, kindly unmute yourself and let me know what your problem is, okay? Today's session is going to be very, very interactive. Yeah. Yeah, we are not going by any formula. What we are going about, we've already done it. So today, we just need to ensure that what each and every one of you really know how to do your stuff, okay? So if on this call today and you really don't know how to pick, like pick out points of interest, and you also don't know how to spot a trend, you don't know how to take a trade, please unmute yourself, yeah, and talk to us. So even before we proceed with that one, today we took a buy position, right? Yeah, so let me explain to you guys the psychology behind that very trade. So there's my 4 hour. Of late, I've not really had time to, like with my system, I don't have to sit down and draw setups. You get it? Yeah, I just wait for market to do its thing. It gets into my zone and I execute. And today was a very clear example of that. Okay. So today, exactly around, was it? Nah, this is 11. Hey, which of them? Supposed to be that one. Wait. Okay. Yeah, so today, exactly around 1 is showing 11 p.m. because it's a 4 hour time frame. Yeah. So around, oh, there's something I'm doing wrong. Let me refresh my chat and see. All right, so I'll show you the actual thing. All right, so let me start. Yeah, so today, exactly around 1:30, there was CPI, right? And one thing I've been telling you guys, if you are to pay attention to what's a very good POI, like a point of interest for you to execute a trade, make sure that what there's been some level of consolidation within that zone. You get it? And this zone is no exception. Okay? This very zone you are seeing over here is no exception. And this even happened on the what? On the 4 hour time frame, which gives it some sort of validity because of what, like the time frame. The time frame is quite what is quite big. You get it? It is on a this one a big time frame. So you can see this level of consolidation over here. It created this consolidation only for what price to what breakout, then later on try to continue what the uptrend. You get it? So during CPI, and you know this thing about always having fundamentals playing according to your technicals. If only the technicals are right, you get it. So let me say if market is in an uptrend and they've been an impulse buy, a news release must form the correction. You get it? And that correction could be just a pullback, then later on, price will continue its rise to the top, right? Yeah, so there's like a textbook play over here today. So on the normal, this is where I would have entered. So we had price getting into this point of interest of ours, but then what did he do? It saw this POI. Hey, all right. So it saw, let me use this one rather so that it becomes clear. It saw our fair value gap, which is over here. So there was a fair value gap in that same point of interest. So I know up to now, most of you here know what a fair value gap is. How many of you don't know what a fair value gap is? Hello, drifting. Yeah, you don't know what a fair value gap is. Please, you can unmute yourself and talk. Okay. All right. So since your hands is up, it means maybe you don't know what a fair value gap is. So a fair value gap, mostly, I'll draw it. I wouldn't like to explain the psychology behind fair value gaps for you guys to get confused. So let me draw it, okay? So mostly, this how to spot, like the simplest way to spot a fair value gap. You guys, pardon me, I'm not feeling that well. That's how my energy is down today. A bit under the weather. Okay, sure. Drifting, I just saw your message. Okay. Yeah, so that's what I'm doing. I'm trying to illustrate to you what a fair value gap is. So last week and this week, we've really seen a lot of fair value gaps, like a lot of valid fair value gaps being respected. You get it? So since we've been seeing it a lot, I guess you guys need to know what that is. So that, but I always say that this things I'm teaching, most of you shouldn't take this thing very serious. Just pay attention to support and resistance on a higher time frame. I don't want you guys to be all over the place trying to spot out some stuff that you may find it difficult to spot. You get it? So just pay attention to the basic concepts. Later on, I don't even advise that later on you try to learn more stuff to it. Uh-huh. Let me bring this down a bit. So this is how a fair value gap is created. This is a previous candle. So if this candle closes with a wick, you get it. Then the candle preceding it also has another candle which comes after it leaving the sun a wick. You get it. So in order for us to, let me say, call or let me say term that side or that particular region to be a fair value gap, there need to be a space. Like the closing of the previous candle must be a bit above what the previous candles this thing what's the name closure. This may sound very technical, so I will spot it out for you. So you see that when this candle closed, it left a gap. It left a gap between here. So we have a gap, a gap here, and a gap here. You get it? So this very gap, we can decide to what? Spot them as a region. Actually, there's a reason for this gap, and that's what I wouldn't like to confuse you guys about. You get it? You see? So that space between like the that space between their what their wicks, that's what we refer to as what a fair value gap. Okay, and this is the same for every, like, the thing is, in order for you to respect a fair value gap, it needs to be in a very good point of interest. You get it? And I've already told you that what, when you want to spot out a very good point of interest, that very point of interest needs to be a consolidation area. You get it? Yeah, price must have consolidated within that spot, then broken it. You get it? So mostly, if it was consolidating and it broke up to the upside, then it's going to form a support for you. You get it? And within that support, as a trader, in order for you to get like riskless, you need to make sure that what you are refining. Okay, you need to make sure that what you are refining your entries in order to get the least this one SL that you can ever get. You get it. So actually over here, like, we've seen the spots, all right. We could have maybe placed this one. We could have maybe placed, let me see, our position maybe above the zone. You get it? We could have placed it somewhere. Oh, why are you picking? We could have placed it somewhere around here. You get it? But then if we are to put it there, that would mean that, Charlie, we are going to risk a lot. You get it? See, price moved like 60, like almost 100 pips before what it got respected. And as a trader, I don't know. I wouldn't advise any of you to be using like 100 pips SL. Now that's very bad. Okay? 100 pips SL. It's like you don't really know where markets will be heading to. Okay? If you really know what you are doing, you need to be able to what, refine your entries to the what least SL that you can get. Even with 0.01, that your 100 pips SL will mean that what, if price doesn't go your way, then you'll be losing out with what, like $10 will be taken out of your account. You get it? Unless maybe your account is huge and you feel like, okay, if I lose $10 just using 0.01, then that's not a problem. Then down our advice. And the funny part is most of you over here have your account size averagely around, yeah, I've never tight so averagely around what, 10 pips. I'm sorry, around $10. You get it. Your average account size is what, $10. Imagine using 100 pips SL, meaning if price should go the opposite side of your this one prediction, then you are going to blow your account. You get it, because your SL is going to be your what? Your account size. You see? So always try to what? Refine your entries. And even with this one, you didn't even have to what? Waste your time to refine it by going to the lower time frame. The position was very clear from here. You get it. So around 130 something or 140 something, I sent out this one a screenshot of the position in play in the group. You get it. The reason why I didn't enter was because I had missed my entry. You see, I actually didn't know what was happening. So when Emmanuel dropped his setups in the group. You get it? So that was when it occurred to me that, oh, it's CPI time. Let me see what gold is doing. Okay. So I went on there and I realized that price has even already what tapped into our point of interest, tapped into our fair value gap, and has already what respected it. You get it? As at that time, the time that I realized, we were like, because me, if I'm to refine my entry on this FVG, always I take the what, the equilibrium. You get it? That's why uh, someone in the group asked where they should place their SL. I cannot give you a specific figure, but always my SL is 20 pips away from what my, what's the name, my entry. There used to be times that I used to use 10 pips. You get it? But 10 pips really brought my win rate down. And I'm more about win rates than risk to reward. You get it? So I decided to what right now move my this thing, my SL to 20 pips. You get it? To allow some breathing room and stuff like that. You see? Exactly. So with me, I always, if it is an FVG, a point of interest, whatever, if I'm refining it, I'm always taking the equilibrium. You get it? So let's draw up. Let's draw up this one, our FVG. So there's our FVG. Perfect. And we'd have taken the equilibrium. So that would mean that okay, sorry, I went muted. Yeah, so that would mean that what we'll be taking our positions around the what the equilibrium. You get it? Okay. You'll be taking it around the equilibrium or something like that. Then, but always when you get it on the higher time frame, try as much as possible to what go down to the lower time frames to pick it up. You get it? But then so later on, we the thing is we missed that entry. We couldn't take the trade. The time I realized price was somewhere around here, around this point. That's like 100 pips away from our entry. You get it? So I was like, nah, that would be late for us to what enter because already too we're in a period of news. You get it? Mostly these news releases, you can't really trust them like that. Sometimes you may see that what price is moving the opposite direction. Before you enter, the enter started reversing on you. You get it? And being in a situation like that is very bad because it will mess up your psychology. You get it? You end up gambling, thinking like price needs to go up, price needs to go down, that sort of thing. You see? Yeah. So always, if you miss your entry, the only time you don't have to like trade your system is if you have missed your entry. You get it? But then if you have not missed your entry and price is around your point of interest, do as like just execute, don't think twice, just execute. You get it? Whatever happens, you learn from it. Okay, that's how to build your edge. All right. So the thing is, so one major confluence I use in my trading is time. I know that by now most of you here know that what I trade exactly at 2 p.m., like 2 p.m. going. You get it? Yeah. So since we had missed this trade, I was like, okay, then let's wait for what price to get, like let's wait for this on 2 p.m. When it gets to 2 p.m., then we'll see what we will do. So exactly at 2 p.m., this 4 hour candle closed. And when it closed, it left off a rejecting candle from our point of interest, which signaled a potential what uptrend. You get it? But I wasn't moved by the 4 hour candle alone. I later refined it to 1 hour. This is what we saw on the one, a very clean rejection to the upside. You get it? And we also had this bullish run also. You get it? So after seeing this, I was like, let me see what's happening on the 30 minutes. So 30 minutes was actually what gave me the confirmation, yeah? Because when I got into the 30 minutes, Price had already printed out this, what was the name? This rejecting candle. It had already rejected off point of interest. It had also printed a very strong bullish candle. And this bullish candle, this is like a point of, let me see, a resistance zone that it created previously. You get it? And Price being able to create like a very strong bullish candle around this resistance meant that what this liquidity is going to be wiped. Like this resistance zone is going to be what's taken away. You get it? It's going to be broken. So when I saw that, I didn't think twice. I just entered for my buy position. Then my average 1:3 daily. You get it? 60 pips. I was out of the markets. You get it? So that was the psychology behind today's trade. Nothing special, no drawing, nothing. You get it? On the normal, you wouldn't see me drawing stuff on this one on my chart. You get it? But then today I'm teaching, so I need to do that. You see, so that's how simple trading is. Never complicated. Just know what you are trading, then execute on the normal. Okay. So yeah, back to the question I asked earlier on. If you are here and you don't really know how to spot point of interest, execute trades and stuff, yeah, kindly unmute yourself and talk to us.
Hello, Sajabo.
Yeah, Elvis.
Yeah, my problem is
Okay.
mostly when you are teaching, like when the mentors are teaching, they say we should always consider higher time frame uh, candles to check out our point of interest and other stuff.
Mm-hmm.
But when we're doing this your particular trade, you use more than three time frames. So does it mean that the higher time frames, okay, when should we use the higher time frames and when should we come down to lower time frames to pick?
Okay. So the thing is, higher time frames validate what you're about to do. You get it? Yeah. So the thing is, mostly I'm a scalper. You get it? So that should tell you that what I'm in the market not for so many pips. You see? So one very way I get to like validate an entry or a point of interest is okay, if it's a whatever, so me I say whatever point of interest you are finding, make sure that what you have first spotted it on the higher time frame. Okay. So let me say if it is a resistance, make sure that what yes, that resistance that you want to trade or that resistance that you want to take yourself, that resistance is happening like it is taking on the what on the higher time frame. Later on, if you are able to spot that point of interest on the higher time frame, then you will refine. You get it. So the rest is just refining. You see, one thing about the higher time frame is you cannot just spot a point of interest on the higher time frame and say that there's the point. Let me execute over here. Nah, you can never do it that way. If you mostly take your positions on the higher time frame, you end up having wide stop losses. You get it? Your stop losses, you tend to what raise your stop loss much higher. You get it? So the thing is, for this very so let me go to the so I was explaining the psychology behind the trade that we took today. So this very one, this very one, for instance, we spotted this point of interest. You get it? And I told you, no matter where you are spotting your point of interest, that point of interest, in order for you to get like 70 to 80% assurance that this point of interest is going to hold, there must be what consolidation within that region. You get it? If it is resistance, make sure that what there is consolidation around that region. If it is support to, make sure what there's consolidation around that region. You get it? And I'm not and this one, what's the name? A pattern trader. Like I don't trade patterns. You get it? But then if this one, Ezra or Brian was supposed to be on the call, they will tell you that what Price had what printed out an inverse head and shoulder. This one he has told you guys. I don't know if you can see the inverse head and shoulder. So we have it here. This side, there's the head. There's the head. There's like the left shoulder. Then there's the right shoulder. Have you been able to spot it out now?
Mm,
Hello, Elvis.
yes, yes.
You get it. So there's like an inverse head and shoulder. You get it. But then I don't trade this one chart patterns. Okay, I don't trade the chart patterns. So you let me come back to wherever I was talking about. So with this very point of interest, you see this point of interest, we've been able to spot it on the 4 hour time frame. But then in order for us to what refine it, we saw that what already it has gotten into what this thing. our FVG, our fair value gap on the 4 hour. But then I told you, if you are to take the trade on this, like this 4 hour, you end up using a very wide stop loss. Even let's say you want to take the trade, even at the equilibrium of the 4 hour FVG, for instance, you end up using like, so this is like 60 pips. You get it? Well,
Uh,
sometimes
so me,
risking, okay.
well, mostly when they say we should, as a beginner, we have to be using higher time frames. So many time I see any, like I open any pair chart and start drawing my POIs and other things. I just try to place a trade there, and I see that every time I do it, I see that the pips are too high.
What pair have you been able to trade so far?
No, like I'm just, but like when I'm at the office, I just log in to the trading view and just try to spot out some things. I don't execute them, but I just see that all are in huge pips on the higher time frames, because we've been taught that you have to be using the higher time frame as a beginner, not knowing after spotting them, you have to come back down to another smaller time frame.
Okay, so the thing is, I wouldn't confuse you. Yeah, just stick to the higher time frame and make sure that you are trading currencies. Don't be trading gold. Don't be trading gold on a higher time frame. Otherwise, you end up with so much this one um like a very wide stop loss. Okay, just
Mm,
stick. So if you are going to trade like what's the name? If you are going to trade GBP USD on a higher time frame like 4 hour, GBP USD zone, if you are finding like a support or a resistance zone, just limit your stop loss to 50 pips. Okay, just limit it 50 pips. So if it's a $10 account, then you should know that you are risking 50% of your account. You get it? But then I wouldn't encourage that. Always and always, if you are even like GBP USD is not that volatile, so you can comfortably this one. What's the name? Use like 10 to 20 pips SL on what GBP USD. You get it? With me, if I'm trading currencies like GBP USD, GBP JPY, and all of those ones, my highest I can go is 10 pips. Averagely, I use 5 pips SL. You get it? But then, no, that one, unless you know what you are doing before you can set that this one tight SLs, okay? But since like
oh,
you
okay.
are
So
starting as a beginner, yeah, yeah, I'm
it
listening
means
to you.
that the higher your time frame, the higher your pips, and yes, the higher your time frame, the higher your pips. As in, you set your SL and your TP on the higher time frame. It means that the higher your time frame, the higher your pips will be. Or if you set them on a smaller time frame, the pips will reduce.
But the thing is, it's all about refining. It's all about refining. I don't know how to explain it to you. I've seen Kabna this one sending something. So I'll give him the opportunity to explain it from his point of view, whether you get it. So Kabna, you can unmute yourself and talk to him.
Yeah, so what I
Actu-
was saying, you can look for your point of interest on the 4 hour time frame. When you find your point of interest on the 4 hour time frame, you drop to the 15 minutes time frame for confluence. I do not know your strategy. So everybody has a set of rules. So I can okay, let me tell you mine. So mine, I look for the daily bias or trend bias. I look for where market is going. So if market is in an uptrend, I only look for buys. So I drop to the 15 minutes time frame. 15 minutes, I look for my POI, which is my order block or breaker block. So order block, I mark out my order block and wait for price to get to the order block. If price violates my order block, I then enter 5 minutes to look for where price will retrace to. Like the extension. I do not know how I was explaining this. So very soon you start using fib extensions. So that would be like where you should expect price to come back from. When price starts reversing from your fib extension, you I am going too far into this strategy. So Do your analysis on 4 hour, drop to 15 minutes and look for your entry. It makes your stop loss very tight, and things like this thing, first like gold really respect the 1 minute time frame. GBP, USD, 15 minutes, 30 minutes, 5 minutes time frame to find your order block or whatever you're looking for. They respect these three time zone, how do you call it, time frames. And Euro CHF respect mostly the 1 hour, 30 minutes time frame for. These are things that your 4 hour and take your entry on 15 minutes. That's what we call time frame alignment. So if you do your analysis on 1 day, you should look for your POI on the 1 hour time frame. If you do your analysis on the 4 hour, you should look for your POI on 15 minutes. If you do your analysis on 1 hour, you should look for it on 5 minutes, 15 minutes time frame. I don't know if you understand.
Yeah, I'm listening.
You
So
say he doesn't know
basically,
if you understand.
you,
Do
okay.
you
But
understand?
So
I
you should
I
align.
don't know. I don't know whether at the end of the program I might able to grasp some. But it seems someone like this guy, Commander, this I'm sure he. Okay, fine. They say you have to know your strategy. But as of now, me, I don't know my strategy. I just want to learn the
That is
thing.
it. You see what they taught you. No, look,
Hello,
you
Captain. We
already
miss you.
have what it takes to build a strategy. You do not just know. Okay, you did not hear. So like what they've taught us trend line.
So
So if
me,
I were to be building a trend line, so I'll just go to trading view, draw my trend line, and wait for price to get to it. When price gets to it, I take note what the price do. Okay, so when price got to my trend line, it bounced and went back up. You dropped 15 minutes time frame and look for what price did over there. Write it down and be like, okay, so next time if price comes back here and follows these rules I've written down, I will take this as my strategy. Like, I do not know if you understand. So you just wait for price to get back to your point of interest. So all you have to know is the trend line. Once you master the trend line, wait for price to get there, and then you build a strategy around the trend line.
okay.
Do you understand? So you know trend lines. I do not know if you understand me. You know your
Yeah,
trend
yeah,
line.
yeah,
So the remaining things
yeah.
are you building a set of rules to follow to if these things I'm not executing my trade. That's what we call a strategy. So the trend line is already a strategy by itself, but then you cannot use only a trend line, only the trend line as confirmation. So above trend line, maybe I'll enter a buy. No. So you'll be like, okay, when price gets back to the trend line, I'm looking for, let's say, a bullish pin bar candlestick, or I'm waiting for price to break structure in, let's say, 5 minutes or 1 minute time frame. That's when I have my confluence, my confirmation that okay, price is starting to go up. Look for a 1:2 risk to reward ratio, and you wait for it to play out or see if it will not play out. Basically, how you build a strategy. I don't know if you understand.
I understand now.
Yeah. So basically, we have everything we need to build a strategy. We just need to go on the chart, just draw a trend line, and then observe what price does when it gets to the trend line.
Oh, okay. So it means some of these things you draw them way before it even reaches there. It's not an instant execute. Like you don't draw them instantly and wait for price to reach there. You just
Like fair value gaps like this. Fair value gaps, they create themselves before price will get back to it. So if you know how to spot a fair value gap, you do fair value gap, you spot your fair value gap, draw it, map it out. I do not know the rules from fair value gap. So when you map your fair value gap out, you wait for price to get back into fair value gaps. So like the way Osajifu was saying, if he sees price at his POI, he takes it as where did he say he takes it as?
The
Boss
equilibrium.
Osajifu, I mean, you take your trade where when it is in the fair value gap.
The
So where do you
equilibrium.
take your trade?
I
Exactly.
take
So
it in the
that is
equilibrium.
his strategy. So that is his strategy. He maps out his fair value gap. Price gets back to the fair value gap. He puts his entry at the time going to be tight. That is the rules he follows. Those are the rules he has set for him to follow. So if he hits stop loss, okay, he knows it did not go his way this time. So next time he maps up another fair value gap. Price gets back to his point of interest. He executes, hits take profit, moves on. Like these are rules you write down for yourself. I don't know if like I'm being understood first. The thing is like set yourself, set a set of rules for yourself, and then execute on them.
Oh, okay.
Okay.
Yeah.
That's well said, Charlie. You really try. Thank you.
So,
Yeah. So